There's a tax deduction worth thousands that 4 million homeowners used to claim every year. It disappeared back in 2021, but it's back in 2026, and we're going to cover exactly what it is and who qualifies. But that's not the only thing that changed. In 2026, several deductions are gone for good, and 2 others just got significantly better. But don't worry, in a few minutes by the end of this video, you're going to be completely up to speed. Let's get right into it. Chapter number 1, the $40,000 SALT deduction. Before we get started, the tax code not only has exceptions, it has exceptions to the exceptions to the exceptions. That's exceptions to the power of 3. So use this information to have a conversation with your CPA, but don't go rogue and DIY it. Let's start with SALT. SALT stands for state and local taxes. This deduction lets you write off property taxes plus state income tax from your federal return. For years, this was capped at $10,000, but the One Big Beautiful Bill Act changed that. Starting in tax year 2025, the cap is $40,000 for household incomes under $500,000. Above that, it phases down. So if you're a high earner in a high tax state, this is likely very beneficial for you. Chapter number 2, PMI is back. PMI stands for Private Mortgage Insurance, and if you're putting down less than 20%, you're paying PMI. You used to be able to deduct it, but that expired in 2021, and now it's back. Starting tax year 2026, PMI is deductible again, and this time it's permanent. Back in 2021, the average deduction was $2,346. Over 4 million homeowners used it annually. The catch? You just needed adjusted gross income of $110,000 or less, and you had to itemize. PMI will be treated as mortgage interest, subject to the $750,000 loan limit. We'll get to that limit in just a bit. For first-time home buyers putting down less than 20%, this can be very beneficial to you. Chapter number 3, points deduction. Most borrowers pay points at closing to lower their interest rate. Each point costs 1% of your loan. On a $400,000 mortgage, 2 points is $8,000. Points paid on a home purchase can often be deducted in full the year you buy. That's thousands of dollars most buyers overlook. There's one caveat. Refinance rules are different. Points on a refi get spread over the life of the loan. So if you pay $3,000 in points on a 15-year refinance, that's $200 per year, not the $3,000 up front. Chapter number 4, the $750,000 limit. You can deduct mortgage interest on up to $750,000 in total loan value. That's not per property, that's combined across both mortgages if you have a primary and secondary home mortgage. Anything above that is not deductible. For example, on a $900,000 mortgage, interest on $750,000 of that loan would be deductible, and the $150,000 above that cap would not be. Chapter number 5, the energy credit. If you search for homeowner deductions online, you'll find tons of articles about energy credits like the 30% solar deduction, heat pumps, and efficient windows. All that information is now outdated. The One Big Beautiful Bill terminated both major residential energy credits as of December 31st, 2025, without a phase down. So if you installed solar in 2025, you can still claim it, but for new purchases in 2026, there's no federal tax credit for homeowner-owned systems. So be sure to factor this into any buying decisions. Chapter number 6, the home office deduction. If you're a W-2 employee, you cannot claim the home office deduction, period. Even if you work from home full-time. The One Big Beautiful Bill made this permanent. If you're self-employed, it's a different story. So sole proprietors, freelancers, and independent contractors can still claim it if the space is used exclusively and regularly for business. You can deduct a proportional share of the mortgage interest, property taxes, utilities, insurance, and repairs. And there are 2 methods. The simplified method gives you $5 per square foot up to 300 square feet for a max of $1,500. Or if it's worth it, you can do the actual expenses. Chapter number 7, closing costs. Your closing disclosure has a lot of fees, that's for sure. Here's the ones that are deductible. Mortgage points, property taxes you reimburse to the seller, and prepaid mortgage interest. Here's what's not deductible. Title insurance, attorney fees, appraisal, inspection, recording fees, and transfer taxes. Keep in mind that most closing costs become part of your cost basis, so they help you lower your taxes when you sell, but not your taxes in year 1. So congratulations, now you're up to speed on the recent homeowner-related tax changes, and as you can see, there are a lot of them this year. Please share this video with any other homeowners who would benefit from this information, and be sure to like and subscribe if you haven't already for more real estate videos like this one released every Friday at 5 p.m. Thanks so much for watching, and I'll see you next week.